However, the crash on the 30th, because of the Fed chair being nominated and because people using that to cover and getting out of shorts, I think is a weak argument that's not going to come to fruition. So I don't think gold and silver are going to be down for long. But they are right now, so we have to talk about it. We have to talk about reasons why people are out of that. And I think there's a lot of risk in the system. You've had Turkey and some other countries sell gold. You've had some people stay out of the gold trade. I think people are waiting to kind of see what the economics look like when we get restarted after the summer, typical summer doldrums. And so I think that seasonal trade in gold is going to play more into it this year because of how far we fell. And we're going to have to see how much we recover. I don't know if we're going to get back to 5,500 gold and 121 silver this year. I doubt it, but I think we'll have a nice little uptick in the back half of the year. And it makes sense if you look at fundamentals and the seasonal trade as to what typically happens. Well, not only that, but you're right, 100% with Nixon. But look back at 1933 with the Executive Order and the Gold Act,
right?
And revaluing gold. So yes, you're right. The U.S. has a history, and the Federal Reserve itself. We didn't want a central bank. We didn't want a central bank. We didn't want a central bank. And then they pass it in Christmas when half the people are in their horses and carriages trying to get home, to South Carolina. And a small group of people pass the Federal Reserve. So
right.
I don't think anything would truly surprise me. I would only be surprised at timing. I wouldn't be surprised at the action. I would be surprised that they're doing it now. All right, so I'll start with July 4th. There's a rumor going around that maybe the U.S. will announce like a gold-backed bond or some similar scheme, which kind of honestly, Daniel, fits in with what we experienced in Nashville a couple of years ago at the Bitcoin conference, where Trump, Omosami, and Loomis talked about the Sovereign Wealth Fund and a scheme with gold bullion and Bitcoin. And it wouldn't surprise me if they've been thinking about these types of things. I don't know that it'll happen on July 4th. It felt like to me that there might need to be more rulemaking. There also needs to be a revaluation of the gold before it happens from a book entry standpoint, because I think on the books, at least, it's valued at $42 and not the 4,000 something we have now. So that may occur. I don't know if it'll happen on Independence Day. It would be welcome. I've talked with some friends that are gold and silver guys, just local friends that I know. And like I had a poker game this past Saturday night with a bunch of friends, and they were talking about it. And one of my friends who's been a longtime supporter, you know him pretty well. He's been involved with C4SM stuff. His name's Steven. He said, I would love if they would do it, but I don't think that they will. He's a little cautious about thinking that they're going to do it right now. And I kind of agree with him. That being said, it would be great if they did. I guess from the standpoint of at least they would be using that revaluation to support the Treasury system. I don't think it's going to solve anything. And personally, I would like other ways of addressing the debt issue. But that's sort of the rumor going around. And so we'll see what happens on July 4th. The rest of it, I've been doing a lot of investigations, what's going on with the gold market. Because on January 30th, we had the big crash, right? And then it stayed down and it's drifted down the last few months. Now, we know general seasonality is that in May and June, prices are down. July and August is usually somewhere in there is where they start to recover. And usually from about mid-August to the end of August through February is sort of the annual sort of bull market for gold and silver, if you will. And then from like March to June, it's not quite as good. But that's not what we saw happen in January. And so there's really an underlying cause for the gold and silver. And so I did a lot of research, and there was an article that came out on Bloomberg that was reposted on Yahoo Finance. And I did a big video on this, hour-long video on this, where they said the debasement trade is over. Debasement trade is defined as anything non-dollar denominated asset like gold, silver, or Bitcoin. And Bloomberg was positing that once Kevin Warsh was announced as the Fed chair, there's no reason to invest in any other assets. Everybody should go back to business as usual and invest in dollars and treasuries and U.S. stocks and those types of things. And I found the arguments in that article a little bit spurious or maybe not well supported. So I did a whole hour on it. But it's funny that if you connect the dots, the date that Warsh was nominated on January 30th was the date of the gold and silver crash. So whether or not that was cover for bullion banks or other entities using this to short cover and cover all their shorts and bring the prices down, I don't know. But there seems to be a correlation between the expectation of what's going to happen at the Fed and the gold and silver price. Now, I'm not so sure that Kevin Warsh is going to be able to do anything that his predecessors didn't do that would be substantial to eliminating the problem. But that seems to be sort of the scuttlebutt around mainstream financial circles as to why gold and silver hasn't recovered. Now, if you look at it from a technical perspective on the COMEX, which I like to do because I'm sort of a data dork, right? And I like to understand how stuff works from the inside. Spent about 20 years as an investigator, cybersecurity wise and audit wise. So I like to look at details. And if you look at the trade, the open interest or the contracts on COMEX where the prices determine the futures market are not up very much on gold and silver. There's been a nice little sort of mini recovery from the managed money category, which are the financial houses. So we're starting to see some retail demand in gold and silver that the managed money is putting into the COMEX, which is how they get exposure in their funds. They don't buy real gold, they just buy the contracts, futures contracts, and hopefully make a profit on those. And that affects the funds that they're putting them in, which would be a benefit to their customers. So we're seeing a little bit of uptick in that, but we've seen a lot of outflows from the ETFs, unfortunately. So retail signs on gold and silver are mixed on those paper type of investments, the ones that go through brokerages or go through ETFs, those types of things. Physical demand has not really slowed down. We've had a massive amount of gold deliveries on the COMEX for the June contract. Yeah. I don't know what it's going to be. We're probably about the end since it's the 30th. I could probably go look at the end of day today and figure out what that number is. But physical delivery is very strong on COMEX. Retail sentiment down across ETFs and across managed money funds investing in the longs on the COMEX. And I suspect that the seasonal trade will bring gold and silver price back up sometime in August. But really, I think it's going to be the catalyst is oncoming inflation. We've already seen inflation go above 4% in May. It was 4.1. Expectations from a lot of leading financial agencies, even mainstream ones, are that we're going to have a strong bout of inflation the last part of the year. Part of it Strait of Hormuz. Part of it is that we had structural inflation tick up in April and May so far that we have numbers for, and we'll see what happens in June. So that's kind of the story on what gold and silver is doing, all the different aspects of it. I'm not worried. Personally, I think the long-term bull case has not changed at all. It's only gotten stronger. And the seasonal changes don't affect me. I've been through these cycles for about 17 years. However, the crash on the 30th because of the Fed chair being nominated and because people using that to cover and getting out of shorts, I think is a weak argument that's not going to come to fruition. So I don't think gold and silver are going to be down for long. But they are right now. So we have to talk about it. We have to talk about reasons why people are out of that. And I think there's a lot of risk in the system. You've had Turkey and some other countries sell gold. You've had some people stay out of the gold trade. I think people are waiting to kind of see what the economics look like when we get restarted after the summer, typical summer doldrums. And so I think that seasonal trade in gold is going to play more into it this year because of how far we fell. And we're going to have to see how much we recover. I don't know if we're going to get back to 5,500 gold and 121 silver this year. I doubt it, but I think we'll have a nice little uptick weakening earlier this back half of the year, and it makes sense if you look at fundamentals and the seasonal trade as to what
some market observers linked the decline to expectations surrounding future Federal Reserve leadership and hopes for more stable monetary policy. Others pointed to futures market positioning, where institutional traders reduced exposure while exchange-traded funds experienced capital outflows. Yet physical demand tells a different story. Central banks continue accumulating gold, and deliveries through major futures exchanges have remained historically strong. This contrast highlights an important distinction. Paper trading often drives short-term price swings, while physical buying continues to reflect confidence in gold as a long-term store of value.
Yeah, I've seen that reported, and I think there are. And I think what's happening is people are going long gold. I think that may be a little effusive because how would you, to get from 4,100 gold, whatever we're at, we're really close to that, to 20,000 that period of time would be completely unprecedented. Hey, everybody in the gold sector would love it. I wouldn't mind. I think it really just reflects, because these contracts are so cheap to get into for big entities, you can take that contract and if it doesn't fulfill, you're not out a ton of money. You're just out your maintenance margin, right? You actually don't have to pay for all the gold in that contract to trade that contract, unless you're either taking delivery or giving delivery, and then the money changes hands. Really, when you're getting into a contract, you're putting a little baby amount in, which is a maintenance or a margin, if you will. And so as long as the trade's in your favor, they don't close you out. If the trade goes against you and you use up all that money, then they'll close you out on a daily basis. So it's not super expensive for these big entities to take that $20,000 bet. And I don't think that they're going to cash out at $20,000. And, but people are tying that in with the July 4th thing,
right?
Judy Shelton and gold, and thinking, is the U.S. going to revalue it But my question is, what are they going to revalue it to? Are you going to go from 42 to 20,000? And if they did, think about that. What would the rest of the market do? I mean, China is charging, maybe it's 4,200 in China or whatever the number is. Are they going to go to 20,000? Are we just going to revalue the whole gold market? And what happened? What happens to the existing COMEX contracts that are in the existing pricing scheme? They're going to have to. The COMEX is on the hook. If you look at it, they're on the hook for paying amounts that traders lose due to exchange-related issues. Now, if it went to 20,000, would the COMEX be on the hook for making due on those valuations? Because somebody's going to lose money and somebody's going to gain money. I don't know. There's a lot of mechanics behind that. I don't know. That it seems to me like it would take a lot of stuff going on for that to happen. But who knows? Government could be working in the background doing a lot of this stuff, and we could see a surprise. I don't know. We'll see. I mean, I think everybody in the gold community would say that 20,000 is a fair price if you look at the world.
Yeah.
But I also think it's going to be difficult to do. Not say it can't be done, but I look at those bets on COMEX as somebody knows that the event is going to happen where the dollar busts or at least crashes and treasuries crash, and they're just taking longer dated positions on that. And they probably stair-stepped in a few months. They probably stepped in December. They probably stair-stepped in other months as an asymmetric long bet. It's like you go to Vegas and you put $100 on black and you do it 3 or 4 times. And if you hit it, it doesn't matter that you lost the first few times. And maybe that's what they're doing. Maybe they're putting some money on black just to see what happens. I don't know. But man, would that be interesting if gold went to 20,000 and the rest of the world supported it? If all the exchanges all of a sudden said, yeah, 20,000 is fair, it would seem to rock the currency markets and the treasury markets around the world, not only US, but think about what would happen to everybody else's bonds if gold suddenly goes up 5 times. It would seem to really screw with the financial system in a lot of ways.
Many economists expect inflationary pressures to remain stubborn throughout the coming months. Rising government deficits, persistent consumer prices, elevated borrowing costs, and expanding fiscal spending continue creating uncertainty across financial markets. Historically, periods of persistent inflation have increased investor interest in precious metals because gold and silver often preserve purchasing power better than cash. Seasonal patterns also tend to favor stronger precious metal performance during the second half of the year. While short-term volatility remains possible, supporters of gold argue that the broader economic backdrop, including geopolitical tensions, central bank buying, and fiscal uncertainty, continues supporting a constructive outlook over the longer investment horizon.
Yeah, I wonder, I kind of think that the U.S. government wants to do this, but I think they want to wait until they're ready for the reset, because I agree with you. It basically would trash the dollar. We have a comment in here from David Lauer that says, for the price of gold to go to 20K would require the dollar to be totally trash compared to other currencies. He says, so the price of gold in yuan might not rise as much if China has gold to back it. So it may call into account several things. Is the dollar really stable? You're going to have mass inflation. I think anybody, even if you didn't have a financial background, would say if you revalue gold to 20,000 and you print that much currency, it's not great for inflation. I think even regular average everyday Joes that don't watch this channel probably could figure that out. I mean, that's an easy one to figure out. And then you've got like I said, the competing currencies. To me, it seems like that's the bazooka they want to fire when they're ready for the reset. And are they ready for the reset? This is really the question. I do think, and maybe they are, hell, maybe they're going to do it before we all expect. A lot of people are saying 2030. Maybe it's now. Maybe they're going to pull it out of the hat and pull the trigger. An element of surprise. The U.S. is going to do this and really throw a monkey wrench into it, because they know that maybe, the dollar and treasury system is in trouble and they've got to do what they got to do to save it. Or maybe this is a trial balloon that they're throwing out to see what the reactions in the financial markets would be. Maybe they're talking about it and rumoring it to see how people would react. I don't know. It just seems like it would be last resort type thing. But I mean, we've been talking about the death of the dollar for so long.
Decades,
Maybe we're here. I mean, who knows?
One of the most controversial discussions involves speculative futures contracts projecting extremely high gold prices, including levels approaching $20,000 per ounce. These contracts do not represent forecasts or guarantees. Instead, they often reflect low-cost, high-risk bets on unlikely scenarios. For gold to reach such levels rapidly, markets would likely require an extraordinary financial event involving severe currency instability, major inflation, or a global monetary reset. Such an outcome would have enormous consequences for bonds, stock markets, exchange rates, and government finances worldwide. Most analysts consider this an extreme possibility rather than a probable short-term outcome, despite ongoing speculation.
Well, not only that, but you're right, 100% with Nixon. But look back in 1933 with the Executive Order and the Gold Act,
right,
and
exactly.
revaluing gold. So yes, you're right. The U.S. has a history, and the Federal Reserve itself. We didn't want a central bank. We didn't want a central bank. We didn't want a central bank, and then they pass it in Christmas when half the people are in their horses and carriages trying to get home, to South Carolina, and a small group of people pass the Federal Reserve. So
right.
I don't think anything would truly surprise me. I would only be surprised at timing. I wouldn't be surprised at the action. I would be surprised that they're doing it now.
Beyond precious metals, the discussion increasingly centers on the future of digital money. Around the world, central banks are researching central bank digital currencies, while private cryptocurrencies and stablecoins continue expanding their influence. Institutions, including the Bank for International Settlements, have emphasized both the opportunities and risks associated with decentralized finance. Supporters believe digital payments improve efficiency and global commerce. Critics worry that government-controlled digital currencies could increase financial surveillance and reduce personal privacy. The central question is no longer whether money will become more digital. It is who will ultimately control the systems that power tomorrow's economy.
Well, it adds it to the monetary supply, but I want to point out it doesn't necessarily add it to the debt because it's backed by the asset, right? So they call it revenue neutral, even though the bottom line is it's not. Nothing is revenue neutral. It's going to create more circulating dollars, but but they call it that, right? It increases the monetary supply, but they're going to write it off on the books as an even trade.
And welcome our co-host. He's been in the back and he wanted to jump in.
Sorry, I really want to jump in on the talk about the Bitcoin, because I tell you what, this is what's really been killing me, is that we've been talking about liberty issues. We've been talking about freedom. We talk about what it will take for us to really revolutionize the world and reclaim our freedom and have sound money. And the Bitcoiners have been arguing for a long time that, Bitcoin is the way to do that instead of gold and silver. And I'm sorry, but the proof is in the pudding. And you look at the way, we didn't prevent the Iran conflict, for example. We didn't prevent tyranny by having Bitcoin. The Mises Institute just put out a really great article. I'm going to put it in the comments. Just recently came out with a great article kind of explaining the problem here is it's been co-opted. I'm so sorry, Satoshi Nakamoto. It didn't go the way you planned, Yes, we created this infrastructure. We designed it for the purpose of creating peer-to-peer transactions. It was created for the purpose of protecting liberty, but we've forgotten much too much. We've forgotten how important it is to just hold what you own. Once you put it onto these exchanges, once the hubs essentially are under the control of a government, it doesn't necessarily prevent the tyranny. Otherwise, it should have prevented the Iran war. It should have prevented the war in Ukraine. It should have prevented a lot of this tyranny. And instead, it was co-opted by a lot of these tyrannical governments.
Whether the next decade brings higher inflation, monetary reform, digital currencies, or stronger demand for precious metals, one reality remains unchanged. Financial systems continuously evolve. Successful investors focus less on sensational headlines and more on diversification, education, and disciplined long-term planning. Gold, silver, equities, bonds, and emerging digital assets each carry different risks and opportunities depending on economic conditions. Rather than predicting a single outcome, many financial professionals recommend building resilient portfolios capable of adapting to multiple scenarios. In an era of rapid technological change and unprecedented government debt, informed decision-making may prove to be the most valuable asset of all.